Hey everybody, welcome to the second quarter scouting report. My name is Adam Koós. I am President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management in Columbus, Ohio. Let's just jump right into it because I have been putting this stuff together for way too long and I'm just ready to get it out there. So, all right, first always a quote of the day. Richard Wyckoff said, the best inside information is on the tape. I would rather follow its indications than act on a tip from J.P. Morgan himself. And all Wyckoff was saying is that when you look at the tape, meaning the ticker tape, when you look at the price of the market, the trend of the market, the momentum of the market, that is what you want to follow is those trends and the momentum and the volume and price movement. It's better than any tip you could ever get off the street. So I just thought that was a good way to start because today, when we look at the stock market, things are looking pretty good. So let's just jump right into the market here and talk, first of all, something I found through Bespoke, which I thought was, Ben Carlson. Ben Carlson put this out, and I thought this was really interesting. I'm a huge history buff. And when you look back at, I'm going to focus on the United States here on the left, but when you look back at the United States in 1900, and you look at the industry weightings going back to 1900 compared to the start of this year, it's really interesting to see that the vast majority of the weightings back in the 1900s were rails, trains, rails. And then you've got some banks in here, industrials, iron, coal, steel, and so on. And then you look to 2024, January this year, and the biggest chunk is technology, then industrials, which, were the third biggest spot. Now it's the second biggest. Healthcare, which was virtually non-existent back then, is a big portion of the pie here. Then retail, financial services, which didn't exist, and then banks, which was number 2 back then. So anyway, I just thought that was interesting. Just want to share it to you. I don't really have any share it with you. Sorry, easy for me to say. I don't have any big, prognostication or anything like that to go along with this table. I just thought it was really interesting. So let's get into the stuff that does matter, though. So first and foremost, asset class ranking. Let's look at how things stack up right now, long term. Right now, they got the S&P 500 is in pole position, the leader of the pack. Number 2 is international stocks. Number 3 is small caps. But small caps, most recently, just at the end of last year, took pole position for a minute, pulled back, and it's keeping pace. Small caps are keeping pace with international, and it would not surprise me a bit to see small caps start to catch up. I talked about that in our market outlook presentation. I've talked about it in articles. I've posted on Twitter or X, whatever you call it these days, about small caps. So I think that small caps are going to have their time to shine here in the not-too-distant future. Fourth in line would be money market, T-bills. Number 5 would be commodities. The only reason commodities are perking up is due to energy, but energy can't do it all. Same with gold. Gold's been breaking out recently, but you can't take the whole index up with commodities. With gold, energy, and cocoa. But and then in the basement, I'm sure for those of you that have been reading any of our articles, that have been watching our videos, screencasts, updates, podcasts, you're probably sick of hearing how bad bonds are. But we're going to talk a little bit about bonds and some maybe light at the end of the tunnel, I'll call it, when we look at the bond market. But at least for the time being, long-term, 20-year treasuries, U.S. Treasury bonds, still sitting in the basement. All right, I want to look at next the average stock. When you look at the average stock in the stock market, one way to do that is to look at the value line geometric index, symbols VLG. And what's interesting about this is you can go all the way back to the late 90s, and you can see the average stock hit a peak in 1998. It did it again in 2007, again in 2015, broke out, pulled back in 2020 during COVID, broke out again, pulled back, and now it keeps kind of hitting this floor of what was previously a ceiling of resistance. It kind of keeps hitting this floor of support and getting pulled back above that line in the sand. And most recently, if I scan in here, I found it interesting that we just recently experienced a breakout, literally within the past couple weeks. Past week, I guess it would be 1, 2, 3, 4, 5. Yeah, past week. Shortened week last week, so technically 2 weeks ago, but 5-6 trading days ago. So this is interesting to see the average stock starting to break out, which means a lot for the market as an overall, a market as a whole. So that's the first thing. When we look at weight of the evidence, I always like to piece things together here. Second thing. Aside from ranking, aside from looking at the average stock, we're looking at U.S. stocks versus international stocks here. Which is better, U.S. stocks versus international stocks? When this chart is trending up, or what I like to do is I like to say, whenever the chart is trading above this 150-day moving average here in blue, whenever it's trending up and above that line, U.S. stocks are better. And whenever it's trending down or below that line, then international stocks are better. And you can see there was a very short period of time, end of 2022, beginning of 2023, into almost summer, where international stocks were outpacing U.S. stocks. But U.S. dollar started to get strong again, and then U.S. started to outpace international, and it's pretty much been that way for quite a while now, and it's very solidly, we're seeing higher highs, higher lows when you look at the comparison, the relative strength chart between S&Ps and international stocks. So what that tells us is that S&P is the place to be. So right here in the U.S., home country bias, it makes it really hard to beat the market, obviously, when your market's the best market. But this is the best place to be, and that's where we need to stay and focus our hard-earned investment dollars is right here in the U.S., at least for the time being, until something changes here. And another thing that I just want to throw out there, and this is bespoke. So I'll put this table out, and I thought it was interesting because what you're looking at here is the all world. I want to focus on this middle one here, the all world ex-US. So it's all the countries around the world, all the countries and stocks within those countries around the world except the US, compared to the US. And when you look at how the major market indices overseas are constructed, you can see they've got a lot of industrials, a lot of financials, a lot of healthcare, discretionary, so luxury goods, and staples, so things we need, materials. When you look at the U.S., on the other hand, you can see, yes, it's got a lot of healthcare, yes, it's got a lot of financials, less so than international, but technology. 30% of the index is technology. Compare that to 13.4% overseas. It makes it pretty tough when technology and AI and software, internet stocks are all doing really well. It makes it really difficult for international stocks to outpace U.S., especially in a strong dollar environment. So kind of an unfair battle, I guess, and that goes back to the whole home country bias thing. If we lived in Australia, then beating the market would be beating the ASX, the Australian index. If we lived in Canada, it'd be beating the Toronto Stock Exchange, the TSX. If we lived in Singapore, it'd be, are we beating the market? Well, the market's the Singapore index. So it becomes a whole lot easier to beat all these international indices if you live there and you're beating your market by investing in U.S. stocks. But if you live in the U.S., on the other hand, makes it really tough. Some people might say, "Oh, you're just making excuses." It's like, well, I am making excuses. I don't think it's fair to sit here and say that in order to beat the market, you've got, and the market's the best market in the world is the U.S., that we got to beat the U.S. market net after fees, taxes, slippage. And then to turn around and say, when the international markets start to outpace the U.S., which they haven't done for a very, call it continued period of time for a while here, but when they do, to say, well, we need to start using that as the new market index. That's the new benchmark, is the international markets. It just, at a certain point, you're just splitting hairs and you're chasing your tail. It just doesn't make any sense. So, but I did find this was really interesting nonetheless. Here's my inverse traffic light chart that I do every single month. And we're very solidly in the green. It's been that way now since the beginning of the year for the most part. The caution area resides right at 4,800 on the S&P, and there's a kind of a cushion there between 4,800 and call it 4,140 or so, where we wouldn't be bearish. We wouldn't be sitting here going, "Oh my God, the sky is falling." But it would be an area of caution or consolidation above and beyond a pullback to that previous high going back to 2022. But that all being said, it wouldn't surprise me to see a consolidation sideways here. It also wouldn't surprise me to see a pullback or a correction. It'd be about 8% or so, 8 to 9% drop from 52.43 down to 4,800. And if we hit that line in the sand, then that would be a point where the market would probably try to hold, or buyers would step in and try to hold that line in the sand. But for now, we're in the green, and there's nothing that we don't really need to worry about that or talk about it until something happens and we need to worry about it. All right, let's look at the S&P on a more call it intricate scale here. We've got the underwater signal here, 200-day moving average, so 200-day trend line. This other one's the 50-day moving average or 50-day trend line. Investments that are doing really well hold their 50-day moving average, and the S&P 500 is doing that. it's way above, a lot of daylight here between the 200-day moving average and price. So it would be, again, one more reason for it to be completely normal to see a pullback or a consolidation sideways. Obviously, I'd prefer a consolidation, as we all would. But one thing I'm looking at here on the downside, or one negative thing, or one negative piece of evidence, is that we do have a negative divergence in momentum. So we see lower highs in momentum, which I'm using 14 RSI, 14-day RSI or 14-period RSI. And when I put fighting here because I feel like this is a negative divergence, but just a couple weeks ago, we saw this kind of slight breakout above that descending line of those lower highs. And it's going to be interesting here in the next week or two to see, does this break out above this descending trend line? And if it does, then it negates that negative divergence, especially if it breaks back above 70 again, which is a bullish line in the sand. So it's fighting that descending trend line. It's trying to fight that negative divergence, and we're just going to have to see what happens. But so far, again, price is up, trends up, moving averages are up, they're sloping up. Things look good. There's just not much negative to say here, aside from that divergence, which is a hint, but it's not a guarantee for things to get bad. Apologize for my voice, by the way. It's been a long day. I started this morning at 6:30, and I'm recording this at almost 10 o'clock at night right now, so my voice is shot. All right, moving on to small caps. I mentioned earlier it would not surprise me to see small caps catch up and do well this year. When I say catch up, you can see on the previous page. Actually, I'm going to go back to the S&P real quick. So S&P, obviously, green zone, right? We looked at the inverse traffic light right here. Very much in the green zone, all-time highs. However, when we look at small caps, it's not the same story. Small caps have been struggling. And it wasn't until just recently, we had a breakout here at the beginning of the year, then a pullback, or I should say a throwback, back below that line in the sand, some consolidation, but higher lows, which was good. Another breakout, and now this time the breakout held that line in the sand. It held those previous highs. So now we're seeing it butt up against this high back here, going all the way back to early to mid 2022. And this is where we might see some sellers come in. We might see some chop sideways. We could see a pullback here to 200-ish on the IWM, the ETF. But at least for now, the trend is up. Higher highs, higher lows. Breakout above this, a lot of potential resistance here. That now becomes support, or at least potential support. And now we've got the potential overhead resistance here, this ceiling above which we need to break out before we can start to see small caps start to contend with those old highs going back to 2021. And what's interesting is when we look at, this is Bank of America, nobody wants small caps. You can see the Russell 2000 stocks represent just 3% of actively managed portfolios, which is half the weight versus a decade ago. So we're starting to see things rebound here. We're starting to see small caps perk up, but meanwhile, nobody owns them. Now, you can take that one of two ways. And one way you can take that is, oh, well, nobody owns them, so it must be bad. Or nobody owns them, so I shouldn't own them either. Or the other way you can take it is, nobody owns them, so if they do start to perk up and we start to see higher prices, higher highs, higher lows, better momentum, better volume, that now we start to see money flowing into it. And when that happens, obviously, the more buying enthusiasm we have, the higher prices go. If there's more buying enthusiasm than selling enthusiasm, price must rise. If there's more selling enthusiasm than buying enthusiasm, price must fall. So what we're seeing is breakouts and catching up in the small cap index, all while major active portfolio managers don't have much of an allocation to it. And as we start to see things change here, it'll be interesting to see if we start to see more money follow small caps, which, full disclosure, by the way, we have not only a position at our office in our clients' portfolios in small caps, but we also have an overweight position in small caps across the board. Interesting chart here. I know everybody loves Apple. A lot of people own iPhones, Apple Watches, and so on, Apple TV. This is a relative strength chart comparing Apple to the Russell 2000. Or in other words, it's Apple versus small cap stocks. And you could draw with your eyes a line here, a diagonal trend line going up. And that trend line's been broken decisively. And on top of that, this 150-day moving average here, or this 150-day trend line, that's been broken. You can see it's been broken before, and you could say, oh, well, it's been broken before. Apple's going to come right back. Well, famous last words. You never just say it's going to come back. Just because it came back the last couple times doesn't mean it's going to this time. But all that matters right now is that small caps are performing better than one of the biggest stocks in the world in Apple. And that means something. I think that gives us some information. So speaking of individual stocks, I'm going to get into some sectors, stocks, but let's talk about some sectors first, ones I like. I really like technology. We continue to be overweight technology, AI. Semiconductors is another one I like, software, but semiconductors specifically, we have higher highs, higher lows, rising moving averages. Those are all good things. Individual stocks. When we look at the top 10 stocks on the S&P 500 right now, so there's over 500 stocks. They have 503 stocks in the S&P 500. We see the number one stock in the S&P is NVIDIA, semiconductor stock, AI stock. And then from there, you go down, you see PVH, Energy, Micron, AMD, another semiconductor stock, Tapestry, Target, CEG or Constellation Energy, Dexcom, diabetes company, Advanced Auto Parts, and it just goes down there. This is some of the best stocks on the S&P 500. What's interesting, more interesting, I should say, is when you look at the bottom stocks, the worst performing stocks on the S&P 500. You get things like Pfizer, Biogen, let's see here, Humana, Tesla, the third worst performing stock on the S&P 500. Charter Communications, and then the worst performing stock, going back 6 months, SolarEdge, solar company. So it's really interesting to see the differences between the bottom 10 and the top 10. And why don't we get into a couple individual stocks here real quick? So I mentioned NVIDIA is the number one stock on the S&P 500 going back over a 6-month time frame, and you can see why. I mean, there's no questioning this is an uptrend. Great company, great stock. It's doing well. We don't get married to stocks around here. If the trend changes, if the relative strength changes in a stock like this, then we have to get out of it. But for now, there's nothing wrong with NVIDIA, that's for sure. Another stock that looks really good, and again, by the way, we have, full disclosure, we have positions in all these stocks, by the way. So our clients own all these stocks. But Meta, Facebook, great stock. Rising, again, higher highs, higher lows, rising moving average, breakouts, all-time highs. Next one here, Broadcom. This one looks even better than the prior two. Maybe not as much relative strength, but still, a solid uptrend, looks awesome. Next couple stocks are the weight loss drug stocks. So Wegovy, Rybelsus, Ozempic, made by Novo Nordisk, looks pretty orderly here, uptrend. And Eli Lilly is the other one. So Eli Lilly also looks very similar. The relative strength between these two, Novo Nordisk and Eli Lilly, tends to play a waltz. It's like a dance. One month Eli Lilly's better, the next month Novo Nordisk is better. But those stocks are all looking really good. So just some things that we own, that we like, that I thought I'd share. A sector that I find interesting, I wouldn't say I'm interested in owning it right now. I'd like to see it prove itself a little bit more, get a little bit more relative strength. But it's cannabis. The cannabis sector has been absolutely bleeding, or we could say drowning, for years. It has not been good. It is the great state of Ohio just legalized cannabis or marijuana, recreational, I should say, in November. It'll be interesting to see if that changes, because a lot more states are starting to legalize it, and as more and more states legalize it, it's going to be interesting as we see more profits come into this sector. So this is what I'm paying attention to. Change gears to bonds. I promised you we'd talk a little bit about bonds in a different way. Bond market as a whole, still doesn't look all that great. I mean, you look at AGG, which is the aggregate bond index in the U.S. You've got lower highs, lower lows, lower major lows. Could this turn into a major low here, a higher major low? Yeah, maybe. We'll have to see what happens. But it needs some time. Things are exactly the same with U.S. Treasury bonds. I don't want to beat this dead horse. You can look at prior videos, articles that we've written. I don't need to tell you that Treasuries are down more than 40% off their highs. It's been ugly. It's been ugly, and it's been frustrating, especially when we talk to clients whose parents are invested heavily in bonds. Clients who are conservative that have been over allocated to bonds because some, compliance department said that you needed to have this cookie cutter portfolio that needed to be invested in bonds. It's been pretty frustrating. There's other things we can own, case in point, short-term treasuries that are, I don't want to say risk-free because there's no such thing as risk-free, but there's other things we can own instead of bonds that are short-term in nature that can take advantage of the interest rates that we've been seeing this last 2.5 years without watching our fixed income portfolios or the fixed income sleeves of our portfolios get absolutely demolished, which is what we've seen for the last 2.5 plus years. So as time changes here, we may start to see this change. I'm watching TLT. This is 20-year treasuries, looking to see if this thing can kind of form a bottom, kind of a falling. This isn't a falling wedge technically, but to see if this can kind of print a higher high, especially get above $100 per share on the TLT. But again, this needs some proving itself. Now, that being said, I promised to be a little bit different today when it comes to bonds. So here you go. There's a couple bond positions I actually kind of like. Don't own them right now. May own them any day now. But I do think that there are some constructive things going on with international debt, international bonds. So this is international sovereign debt. I'm seeing higher highs, higher lows. Nothing super exciting here. These aren't, when you look at the scale on the right, $20, $21, $22, you're not talking about a ton of money being made right now. But when you look at things over time, if this thing can catch a trend and can continue printing higher highs and higher lows, then all of a sudden we can look at a total return being something that's a little bit worth owning as opposed to what we've seen in the past, which has been declining rates on long-term debt, all while principal falls, which makes no sense to own when you're seeing what we saw here and going back to 2021, 2022. And the other one here is convertible bonds. This is ICVT. ICVT is a basket of convertible bonds. These are basically bonds that convert to stock. And you can see here, again, it looks kind of like PCY, the previous chart. We got higher highs, higher lows. This 200-day moving average here, you spend some time underwater, a little choppy, but it's to me, this is an uptrend. So I think this is constructive. And I think especially when it comes to the stock market, we start to see, more breakouts in the large cap stocks, mid caps, small caps start to catch up. All of a sudden, this stuff starts to look a little bit more attractive as well. All right, let's switch gears, talk about gold, alternatives, things like that. I'm going to skip the dollar today, by the way. I'm just going to skip over it. U.S. dollar strong. There's not much that's really changed all that much. But gold has broken out. There's no, I could have my fourth grader could tell you gold's broken out here. We got a breakout going back multiple years here, so 4-year breakout. We got a little consolidation here, right here in the middle, just this past month in March, and it's starting to head higher. So the question you might be asking yourself is, should I own gold? Well, gold isn't a bad thing to own right now, but that all being said, we have to compare any investment we own to other investments. So just because gold looks like it's doing well doesn't mean it's doing better than other investments. So for instance, is gold doing better than Nvidia? No. Is gold doing better than Facebook, Meta? No, it's not. Is it doing better than the semiconductor index? No, it's not. So we have to look at things not only on an absolute basis or in absolute terms, but most importantly, we need to look at things in relative terms, because we can't just look at if we looked at things in absolute terms and that's it, before you know it, we'd have so many freaking investments because anything that looked good, we'd own it, and then we just have a hodgepodge portfolio, and before we know it, we'd feel like we're lagging in performance, let's just say, because we don't own enough of the strongest stuff. So when we talk about diversification can be a bad thing. It can hurt us actually, because we can own too much, and we can spread ourselves to the point where all we do is we own an index here. So gold does look good though, and gold as time goes on here, as it starts to chop, consolidate, pull back, higher highs, higher lows, holds this 193 in the sand on GLD, there may come a point here where it makes sense to add gold to a portfolio, but for us right now at least, not yet. All right, what else do we got here? Bitcoin. So Bitcoin, you might have heard a little bit on the news, obviously choppy, volatile investment here. bottomed out at the beginning of the year, technically end of last year. And since then, higher highs, higher lows, starting to contend with all-time highs, Bitcoin. And then Ethereum is looking similar. And when we look at both these investments, they look similar. You can go back and forth between these charts, hit pause, go back on your video player. But when we want to compare the two, we want to do a relative strength chart. So this is kind of like the U.S. versus international chart. And I know the label up here says Bitcoin versus Russell 2000. That's incorrect. The software just didn't update when I printed this chart, or when I snagged this chart or screenshot this chart. But this is Bitcoin versus Ethereum. You can see here in the watermark. So when the chart is going up, Bitcoin is the better investment to own. When it's going down, Ethereum is the better investment to own. You can see Ethereum has been the better investment, not only through trend, but this 150-day moving average here that I kind of use as a line in the sand is another kind of just, triggering mechanism, if you will. And so it's been the better investment to own. Just now, literally in the last week, we've seen Bitcoin break out above that line. We're starting to see almost a upward sloping 150-day moving average. So we may see Bitcoin start to outperform Ethereum here at this point. I don't know. Again, time will tell. This could also come right back down again. We could see Ethereum continue its strength. We're just going to have to see what happens. But speaking of diversification, I saw this. A mentor of mine, Greg Morris, read his books. Just a great investor, retired portfolio manager. Wonderful if you haven't read his books and you're interested in learning more about this stuff. Investing with the Trend, The Complete Guide to Stock Market Indicators, Candlestick Charting, things like that. He's got great books on the market, and especially Investing with the Trend. It's a wonderful book. Very heady, very nerdy. But if you want nerdy stuff, then Morris has got it. So another friend of mine, Dave Cox, up in Canada, he posted this on his monthly market chit chat, and I just thought it was so good because I've done back between 2007 and 2017. I used to do these presentations a lot where we would talk about diversification, which is just kind of a misspelling, an intentional misspelling of diversification, because again, there is a such thing as diversification being bad. So we don't want to diversify. We want to diversify, and the difference is here: owning uncorrelated assets. So owning different assets that do different things at the same time reduces risk, right? So owning uncorrelated assets reduces risk. That's good. That's a good thing. However, just simply owning uncorrelated assets for the sake of owning them, even if they're falling in value, well, that reduces returns. So, for instance, we don't want to own international stocks if they're falling in value and if there's something else we should own instead, like, for instance, U.S. stocks. We don't want to own the general commodity index if we could just cherry pick energy, gold, maybe silver, for instance, cocoa, which there's no way, unfortunately, to invest in cocoa on the Amex anymore. They delisted it, but futures, it'd be cocoa futures, obviously, but you wouldn't want to own the whole index. You would want to cherry pick specific investments that are doing well. But when you do a top-down analysis and you say U.S. stocks are the best of all the major asset classes, then you can drill down into the best sectors, and then you can drill down into the best stocks within the best sectors, within the best market. And then as markets change, and we start to see maybe commodities outperform like they did in 2022, now all of a sudden we own a lot of, say, energy. We own gold. We own things like that because everything else is falling, and it doesn't make any sense to own uncorrelated assets that are falling in value because that reduces returns. So owning uncorrelated assets that are rising increases risk-adjusted returns. And so quick thank you to Dave Cox. Very well put. I thought that was really cool. So I totally stole it from you here. But anyway, moving on to some indicators, seasonality, things like that. First and foremost, again, this is just more weight of the evidence type stuff. This is the percentage of stocks on the S&P trading above their 200-day trend line or 200-day moving average. And you can see here the S&P in the upper pane, lower pane, percentage of stocks above their 200-day moving average, 81%. I mean, it doesn't get much better than that. So this is good, great evidence. Next one here, again, S&P is going to be in the top pane every time. This is the S&P advanced decline line. So it's basically taking the number of advancing stocks every day, subtracting the declining stocks, and plotting it over time. And what we want to see is this line rising because that means more stocks are advancing than those that are declining. You can see here last summer we saw a breakout in that advanced decline line on the S&P going all the way back to 2022. beginning of the year, and then a pullback between summer and October, and then another breakout. And here we are with a nice upward trend line in the AD, and that's, again, more good evidence. So things look good there. Next one, this is RSI. This is a momentum indicator. What we're looking at here is what percentage of stocks are below 30 on their RSI, their momentum indicator, and it's 0. So that tells us that there are no stocks on the S&P 500 that currently have an RSI below 30, which is the bearish line in the sand. Not a single stock. So this looks really, really good. Now, when I say not a single stock, by the way, this says 0, but there's rounding. So there could be 2 or 3 stocks, because there's 500 stocks. It could be 0.63, or I guess it wouldn't be 6.63, 0.43 or something like that. So, but bottom line is very, very few stocks exhibiting bearish momentum ranges, which is obviously, again, more positive evidence. In fact, if you've ever heard of the null hypothesis, and when you were in school, if you ever took any science classes, math classes, I don't know, any of these classes where the statistics, you would look for the null hypothesis, because you don't just want to prove that something's happening. You want to prove that something else isn't happening, and that's the null hypothesis. So we want to prove that there are not a lot of bearish momentum, or is not a lot of bearish momentum on stocks within the S&P 500, and that's what this is telling us, essentially. All right, next one here. This is the percentage of stocks in the S&P 500 that are within 20% of their 12-month high. 87%. 87% of stocks in the S&P 500 are within 20% of their all-time high. That's a lot. Similarly speaking, only 21% of stocks are within 20% of their 12-month low or 1-year low. So, and that number's declining. So, again, more positive evidence here. This chart came from Julian Timmer at Fidelity. I want to make sure I give him a quick shout out. This is for people who are worried about rate cuts. Rates go down, the market's going to do bad. Well, that's not the case. This is, you can see here, going back in time. Excuse me, going back in time, when the rate cut has happened, leading up to it. This is so going back months on average, when a rate cut has happened, to the day it happened, and then what happened afterwards. There wasn't a single time, you can see here, 1921 being the worst, when the market went down going forward. So don't worry about rate cuts, as I guess what this is telling us. Next one we have here, my friend Ryan Dietrich always has great tables, great charts. So I stole this one from him. So the Fed has cut stocks at all-time highs, and bulls liked it. This just kind of goes along with Jurian's chart that I just showed you a second ago. So this is the S&P 500, so the market's performance after Fed cuts when the market has been within 2% of its all-time high. And ignore the chart. I know the chart's pretty and all, but focus on the numbers. So when you look back at time, on average, at every time the market, or I should say the Fed has cut rates when the market's been within 2% of its all-time high, which it is right now, the 12-month return is 13.9%. 6 months later, almost 4%. Median over 6 months is 6%. It's a little bit of a negative skew there, or sorry, positive skew, my bad. But anyway, 12-month average, 14%. So if, again, one more reason to not worry about the Fed cutting rates, I think that would be a good thing for the stock market, not a bad thing. Another chart, another table here from Ryan Dietrich. This is, the market has seen 118 52-week highs now, using the first signal in 6 months, so going back 6 months. And when you look at every time that's happened in the past, the average return going forward has been 12% over the next 12 months, 6.6% over the next 6 months. And by the way, over 12 months, 100% win rate. 13 out of 13 times since 2009, we've seen things higher. So, again, I just keep saying it. I'll say it again. Just more positive evidence. Not seeing a lot of negative evidence is what I'm trying to say. All right. Another clue, this bull market has legs left. When you look at November, the market was up. December, the market was up. January, February, and March. So all of those months, the market was up. When that's happened in the past, you can see what years it's occurred in the past. 1950, 54, 61, 71, and so on. I won't bore you with reading it to you. But bottom line is 100% of the time for the final 9 months of the year, the market was higher with an average rate of return of 12%. Worst one was 1.4. second worst 1.6, third worst 3.3. Median 11.2, which is right along with the average. So not so bad. Again, more positive evidence. Here's another one. We're talking about politics now. So stocks, they can predict who's going to win in November, but it doesn't work every time. So on the right column here, was the stock market right? You can see whenever the market is up on election day, when an incumbent is running for re-election, it predicts the incumbent's going to win. So essentially what this is saying is that if the market's up on election day, then Biden would win re-election. The win rate you can see here going all the way back to 1928. 20 out of 24 years this indicator has been correct. The times it was wrong: Eisenhower in 56, Nixon in 1968, Reagan in 1980, and then you can see here Biden won in 2020, and the market was actually up at that point. So this is interesting. It's not obviously a 100% win rate by any stretch of the imagination. There is a few losses in there, but if the market's up, we'll have to see what happens. It's going to be an interesting election year. I'm going to do my best to pay as little attention as possible because I like happiness. So there's that. We have, speaking of election years, we have the election year cycle. Up top here, this is the election year. If we go down there, sitting president running is the next line in the sand, up anywhere between 12 and 14%. And then the aggregate cycle is basically all election years, having nothing to do with who's sitting as president. And then this year, we're basically entering a time period. If you look at this black arrow going right, what this is basically saying is that we're entering a time period where, seasonally speaking, the market has a tendency to pull back through June and then start to rebound through September, but essentially go nowhere between now and September. So it should not surprise us, after seeing such a good first few months of the year, to see things either pull back at worst or chop sideways or consolidate sideways. Obviously, anything can happen. I say "or" as if what I want to do is I don't want to give or communicate to anyone out there that when I say it could, pull back worst case, to say that's actually worst case scenario. Obviously, the market could crash, right? Things could go nuts to the downside. They could go haywire. Not seeing a lot of evidence that suggests that right now. So when we look at the averages, what I'm saying is that realistically speaking, we could see a pullback in the market or a consolidation sideways. And another thing I wanted to share, which is really interesting, is that we are at a point now where there is more than $6 million of money market funds, 6 trillion actually, of money market funds sitting in just cash. And when we see cash levels get high and those cash levels start to decline, in other words, that means that money's going somewhere. There's a lot of cash there that could go into the market and could obviously start boosting stock prices, especially as rates start to get cut and the short-term and long-term rates, for that matter, start to go down on the less, quote, safer money, if you will. And as a result, that could push markets higher as well. So there's a lot of evidence out there that's suggesting things are good. We've got good stock prices. We've got rates that are probably not going to get hiked from this point on. We're probably going to see rates stay flat and then see rates start going down. Rates go down, that's good for mortgages and mortgage rates and home buying and refinancing. We start to see cash levels get reinvested back into the market. If rates go down, people want higher yields. They can't get the yields at the bank. They can't get it in bonds. Short-term rates go down, so they start putting money into riskier assets like stocks to get a higher return. So all these things are pointing, for the most part, I don't say everything is pointing positively, but most things, the weight of the evidence is definitely pointing positive. Now, if we look at the weight of the evidence, none of this matters. None of it. Nothing I've said so far today matters if you don't have a financial plan. And I know some of you out there that are really, really nerdy might be rolling your eyes at me right now, but it's true. Even if you are one of the wealthiest people on the planet, you need a tax plan. You need an estate plan. You need a trust planning. You probably need charitable planning. You probably need irrevocable life insurance trust to keep money out of the government's hands and so you don't pay a death tax. So it doesn't matter if you're super, super rich or if you are growing your retirement, trying to retire on time, or if you're already retired and you feel like you're a little bit nervous about how long the money's going to last. Everybody needs a financial plan. Not everybody needs every module within a plan. Like somebody with a total liquid net worth of $3 million probably doesn't need to make charitable planning, put at the top of their list. But the reality is the markets go up, they go down. Sometimes they go up fast, sometimes they go down fast. There's an old saying that the market takes the escalator up and then the elevator down. And it can be pretty scary sometimes, especially as you get closer and closer to retirement. So it's crucial to have a written, living, breathing financial plan, stress test that plan above and beyond all this investment stuff. This investment stuff's fun. I guess it's kind of cool. But at the end of the day, you got to have a plan in place. Otherwise, you're kind of investing and you're hoping you have enough, when hope isn't exactly the best strategy. So when we boil everything down here today, what we're looking at is our strategic models, our static models are invested 100% to target. They always are. Invested in the playoff teams. They're focused on small caps, AI, software, technology, semis or semiconductors, internet stocks, food and beverage, and some other things. Our tactical trend following models are also invested fully to target. That's because the trend is up pretty much across the board, so things look good in the market right now. And the focus is also in all of the same or at least similar asset classes, sectors, subsectors. And then in our ESG model, our environmental social governance, essentially our socially responsible model, also invested fully to target, and the focus is on AI, software, tech, semis, retail, and industrials. So last but not least, back to bonds one more time. We're still fully invested in our bond sleeves in short-term treasuries, so 1 to 3 month T-bills, just kicking off, 5.3, 5.4%. And we're going to continue doing that until some of these international bonds, convertible bonds, start to show a little bit more life, prove themselves a little bit more. Then there's a good chance we're going to probably find ourselves dipping our feet in the water when it comes to some longer dated bonds. But with that all being said, that's our quarterly scouting report for the second quarter of 2024. If you have any questions, please reach out. You can contact us at info@libertaswealth.com if you have questions. If you'd like to set up an intro call with me, you can reach out to info@libertaswealth.com or go to libertaswealth.com and click on the button that says contact us, or see if we're right for you or if we're a good fit for you. I forget what it says exactly. You can answer a few questions, and then somebody will get an intro call on the calendar for us to chat confidentially about your financial situation, your portfolio, and so on. If you'd like a second opinion on your portfolio, your retirement portfolio, or your financial plan, or if you don't have a financial plan, please, by all means, reach out, set up that intro call, learn more, answer some questions. Worst case scenario, we part as friends. You can get a hold of us on all the socials. Again, the website, if you want to sign up for these videos, articles, and podcasts and other material that we send on a daily basis, feel free to head out there and get signed up for that list as well. Otherwise, I hope you're having a wonderful spring. Enjoy the weather as it starts to warm up, and we'll talk to you soon.